FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 6/3/20. Well, much going on. The riots continue, but they seem to be running out of steam. Although the will of the body politic, certain elements don't seem to want to do anything about it. Why would that be? Why are they pushing a revolutionary narrative? Well, that's something you're going to have to figure out on your own. But if you want my opinion, and I'd like to know yours, email me, kl@kerrylutz.com, kl@kerrylutz.com. We have a new guest, and I think you're going to enjoy what he has to say. We're kind of connected in different ways. Your name is Nels Stemm, and your company is Fairview-Partners Investment Management, LLC. And Nels, you're Austrian economist like myself, so we're going to be talking about gold, real estate, and debt deals, something we both had a lot of experience in. So I want to welcome you here. Just tell us briefly, precious metals. We'll start with that, because that really kind of is the crux of Austrian economic theory. Where are we right now in the precious metals bull cycle?
Hi, Kerry. Yeah, I think if you take a long view on gold, and I think people have seen the bottom, the fairly long bottom that happened, and very long consolidation, and now seeing a lot of strength coming into it. And my view of that strength is not necessarily just based around the Fed, inflation, all of those matters. It's somewhat informed by my experience in the distressed debt markets and really seeing the potential for debt contraction. And, going back to, I'm sure what of kind of Exeter's pyramid, right, where gold is at the bottom of this inverse pyramid, and all these other financial products are pyramided off of it above, right, with derivatives and debts and different things like that, and just having such a huge amount of that, and gold being the one asset, the one financial asset, which is not someone else's liability. So, in the end, it takes investor demand, right? I mean, you can say, well, the Fed's going to print, so gold's going to go up. But if investors don't, or I should say savers, because I believe gold is saving, but the industry calls it investor demand. If savers and investors don't agree with you, it's not necessarily going to go up. And my view is that they're going to agree with that, and they have been agreeing with it. They're going to continue to agree with it because it has no counterparty risk, and it's a great store of value.
Yeah, agreed. So no counterparty risk. Also, it's 5,000-year history as being a store of value and a medium of exchange. It never goes down to zero. Of course, its value will fluctuate against paper money, or fiat, as we say. Any fiat that isn't simply a warehouse receipt that's convertible into gold is going to vary in value, isn't it?
Yeah, but I think that investors and savers, I say investors in the sense of someone who wants to increase their wealth, right? Let's just put it that way. But I think those people who want to increase their wealth, they do need to understand what gold is not. Gold is not an investment, right? So if you were there in 1920 and you had a $20 bill that you could convert into gold, it was a good idea to convert it into gold, and you could save it till today, and it's worth $1,700 the ounce of gold. The $20 bill, not worth a heck of a lot in comparison to back then. But the Dow is worth substantially more. It's worth many, many thousands of times percent up. And there is some, inflation, and that's going to mean revert. But, that investment in a productive asset is still something which is important for people to do, right? So I believe in saving in gold, and I believe investing in productive assets. I just think today you're going to be better off saving in various ways, because I think that asset prices have had a long run up, and I think that they could have a kind of a grinding path down. So that savings could be in I think people should diversify their savings into literal, cash bills, into short-term treasuries, not long-term treasuries, but 6 months to 3 years laddered, and into gold bullion. And then I think that they should invest in the production of honest money, which is gold mining shares. And I think those right there, that's kind of my wealth building strategy for the moment.
All right. So let's talk about the stock market, because I honestly used to share your view of it. But after seeing the pandemic and now after the riots, we're going to see yet another stimulus package. We're seeing tremendous money printing taking place. And the people that get the money first are the ones who are most likely to throw it into the market. So I will tell you that, I felt that the crash was coming, knew it was going to come. But now that it's happened, it looks to me more like an intermediate crash than a long-term start of a bear market. What's your thoughts?
Yeah, I mean, I think if you've looked at really, really big bubbles, they've taken really, really big bounces. So, what I would say is I would be very careful with that theory out till, maybe August or something like that. We can have, if you have a massive bubble, you got a big decline and a really big bounce out of it. I just think that there's so many different fundamentals that take some time to work through. As you and I were talking about these distressed debt deals, but it takes a while for those transactions to happen, different ththings like that. We were talking before we got online, and you have things like, Hertz is about to sell a bunch of cars right now, but they have a 30-day cure period and a 60-day cure period, different things like that. There's these different financing structures that people came up with. What I'm trying to get at is it just takes several months for a lot of these different stories to roll through. And I think there's a lot of stories that are going on right now. And I don't know that, the Fed can unbankrupt a major retailer and all the down the line effects that those have. So some people have phrased it as, the Fed can solve a liquidity crisis, but can they solve a solvency crisis?
Yeah,
I don't know.
I've heard that one
I don't
before.
know that they can solve a solvency crisis, right? And so, but there's certainly that risk to it. I mean, that's why I think that, savings in gold, investments in gold mining shares, and then on the other hand, still having liquidity in short-term treasuries, I think is also, you have something of a hedge bet there. I don't know why I would go into the general stock market when I could go into gold mining shares, for instance.
Yeah. Hey, like I say, I share your viewpoint here, but my gut feel is telling me market's going to keep going up because interest rates, until interest rates start really increasing, I just don't see any alternative to the stock market. So talking about debt deals, opportunities, what do you look for in that type of situation?
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
So we are buyers of distressed debt, primarily secured debt, like basically a real estate mortgage, let's call it. And, the last several years we've bought, I've bought more debt at 92 than 42, because if I am willing to pay 92 for something, then that means that I think I'm going to get par on it, and par plus perhaps some arrears and some interest and things like that, right? So because the value of the real estate might be $10 million and the debt is 6 or 7, and it's kind of, people wonder, why would anyone sell that? Well, just because it's a very messed up situation, extremely bad situation that the bank just kind of wants out of. And so we've looked for those opportunities. And, as a result of that, we feel like we're sitting here pretty good with our portfolio. Now, as the market turns and the equity gets cheaper, we've done that because we thought the equity was expensive. And as the market turns and we think the equity gets cheaper, then we're going to look for more. Hey, I'd rather buy it at 40 cents on the dollar or something, so that I can then kind of ride the equity out of a different cycle. But that seems like that's a little ways away. It's still sort of a market that's, the real estate market and the debt market. I would say the real estate market more than anything is still a little bit just a wide bid-ask spread and a lot less kind of going on.
Yeah. Well, and we've got, after the pandemic, we got 6 million people on deferral. We've got real estate issues, like you mentioned, coming out the wazoo, and certainly the riots didn't help that any. A lot of strong headwinds ahead. Does that mean more opportunity, or does that mean you should get the hell out of Dodge?
I mean, I think it's more opportunity after a certain point, but I really feel like pricing has to come back. And what you talked about, if I go back from an Austrian perspective, because I think the Austrian stuff, I've been a follower of Austrian economics for probably 20 years. I think that there's a lot of people that should go back and look at some of the original work and really consider, von Mises wrote The Theory of Money and Credit, right? Yes. Not the theory of money or the theory of fiduciary media. It was the theory of money and credit, and that credit then contracts and really causes more of a bust. And so the whole Austrian, thinking of everybody seems to revolve back around inflation. And to me, what they're really saying is the Fed will be able to do their job, or the Fed will succeed. And I think that the Fed will fail. I believe that markets are stronger. So I think that there's an assessment that has to happen there. And part of that assessment, if you go back to bringing it back to what is the opportunity set, what you're going to see is assets become a liability rather than a burden, right? Because there was this malinvestment, which for investors is really overcapacity. Like Austrian economists don't really like that word, but as an investor, I think it's a perfectly fine word. So there's this overcapacity of real estate, overcapacity of different items. And, we've seen in previous real estate busts where, you have a vacant office building. That thing, if it's in Houston, it needs to be air conditioned. You have to pay the taxes on it. All of these things. So these assets become more of a burden on many of them,
liabilities.
Right? And there's nothing that what is the Fed going to do to kind of inflate that when something becomes a burden, right? There's not going to be investor demand for some of those things. And so you want to avoid assets that have carry costs to them. You want to have, either you want to have cash flowing assets, or in my view, what you want to have is the production of liquidity, which is gold miners. Again, what is your product that you're producing? And the product that gold miners are producing is savings and liquidity. And we are going into a period where I think we need more savings and more liquidity based upon my own view of an Austrian analysis, where you had overcapacity and you have all of these assets that essentially need to be carried, right? Because I carry certain assets. I try to get rid of them really quickly, but I might end up with a vacant office building or something like that. And I've been very good in the last several years to just get these off the books, because I didn't want to hit a point like today where all of a sudden I was carrying a negative carry asset, right? I only want to have positive carry assets on my books, or I want to have investments in gold mining shares.
Gotcha. And that makes complete sense. Totally logical. And I agree with you. And I know that the Fed will fail eventually, but there's a lot of money to be printed between now and then, a lot of opportunities that'll be created by the distortions of the Fed. And, look just at the pandemic, how much money got printed. And now with the riots, probably good for another $1 trillion. Before you know it, we're going to be at a $10 trillion deficit just for the year. And nobody seems to care about that. So we're going to see a lot of major gyrations. But in the end, the stock market will be the recipient of, in my opinion, of this excess liquidity, because it's got no place else to go. And inflation, if it kicks in, stock prices will go up. They might not go up as fast as inflation, and we should define inflation. There's what the average person, Joe Sixpack, perceives is when he goes to the supermarket or to the liquor store and his six-pack has gone up 10%. That's inflation to Joe Sixpack. To you and I, inflation is something totally different. It's an increase in the money supply that gives way to increase in asset prices and consumer prices. And we've seen the asset prices, the bubble for the past 10 years, get bigger and bigger and bigger. Now maybe it's popped or maybe it's stopped growing for a while. But no doubt, it's going to resume its path here. So the question is, gold mining shares, putting your savings into precious metals. What's your take on silver?
I like silver a lot. I mean, I think that, what we've seen in silver where people are, I've been surprised by the extent of the gold silver ratio, but I'm not, in a sense, I was expecting that it would go from 80 to 125 based upon a credit contraction. That's what it's done for a very, very long time, right? Because silver is the semi-industrial metal thing. I agree that it is, but it's just sort of the junior currency, right? So it's, the gold is a AAA bond and silver is sort of a triple B bond. It's on the verge of junk, but right today it's kind of selling as deep junk. And so I think that, and it's also that gold, I do believe that gold is money. It's not acting as currency today, but gold, the further it goes away from being currency, I think silver just amplifies every move, as we know, right? And it's just amplified that move even further. So it's further and further away from money. But as gold comes closer to being money through various means, even if they're sort of stealth means, it draws even closer to that point, and that gold silver ratio should come back down. I don't know that it's the geological fact of it or anything like that, but it's the money of everyday commerce, and as you know, gold is the money of sort of capital and major business transactions. And so if you're forecasting that gold is going to come and be remonetized or recurrencyized in a sense, then silver would come in even more. But I would say that there's one more, under my sort of view of things, there's one more possible whack at silver, because if it does go under currency stress again or credit stress again, then you could see something change there. And I wanted to touch on, I definitely get what you're saying. You could have heard maybe this talk or my view on it in 2008 or even in 2001, right? And they've kind of kept it going. I suspect there's something different with this one. And looking back at it, maybe it is that solvency versus liquidity issue, the corporate buybacks that went on for so long and just that dragging nature of debt that starts to really, really gnaw at the fundamentals of the situation.
Yeah, the debt obviously unsustainable, unserviceable, except by monetizing it. And that's going to have its own ramifications. As an Austrian, you'd almost rather see them just get rid of the tax system and just monetize the government's operations. But then what little discipline there might be, which there's probably none right now, would totally be gone because they could spend whatever they want and you'd never get the bill for it, except in the lower purchasing value of your fiat currency, whatever it might be. But the whole tax system, as a means of controlling and keeping the public at heel and rewarding your friends, all the things that political systems are so good at, make that kind of an impossibility. Anyways, so your top three investment themes for the coming year and maybe for the coming decade, just go over them again, because I think they bear repeating.
I would say saving in gold. I would say for the next, 2 to 3 years, having some savings in high grade, in treasuries of short duration, right? And so you might have a laddered portfolio from 1 to 5 years, right? And as what I think could be a possible deflation or just chaos happens, then, you could start to maybe invest those. I do think that there's a possibility that some of those things trade negative. And what people haven't understood about why they were trading negative is, in October of 2008, would you rather have a bank deposit with Citibank or would you rather own a 6-month treasury? Mm-hmm. You'd rather own a 6-month treasury, right? Yeah. Because there's no such thing as cash, right? You might have $1,000 in your pocket. Maybe that's cash. You have $100,000 in the bank. Maybe that's cash with the FDIC and different things like that. Show me $1 billion of cash, right? It does not exist. There is only higher and lower grades of debt, right? We're told Warren Buffett has $120 billion of cash. What he has is $120 billion of different debt that is of varying grades, generally very high and generally very short duration, right? And when we go back and we look at Warren and the view that he had on gold and sort of referring to gold as an investment, that tells me right there that he doesn't even know what it is, right? So if he's one of the preeminent investors in the world, he's actually one of the preeminent savers in the world. And so he should have been saving in gold for the last 20, 30, 40 years because he would still have that base level of, let's say he had $5 billion of gold or something like that. So have that gold for your long-term savings, have the highest quality, recognize that money is really just debt today, and have the highest quality of it. So don't take credit risk with your bank for free, right? And have short-term treasuries. And then again, looking at the production of money, of real money, of honest money, that's what gold and silver miners produce. I would be overweight silver today as a bullion. And then you're waiting for, our look is not, hey, we want both the stock market to go up and the gold, market to go up. Ours is sort of financial assets gets cheaper, and we're invested in productive assets which produce gold. And we think that those become more valued during a credit crunch. And then you're able to transition back into financial assets and cheaper. So at cheaper prices.
Yes, for sure. Could not agree with you more.
It's time to be conservative. I mean, a lot of the people that believe in inflation, if you really believe in inflation, take out as much debt as you can, right? And go out and attach yourself to assets. But I think a lot of the people that don't believe in inflation, they don't go do that.
Yeah, great point. And it's worked. That strategy has worked for me in the past. Not so well in the past 10 years, but prior to that, it was a surefire strategy that never failed. Well, I know people are going to want to find out more about you, connect with you on the web, Nels. Where do you hang out? Where do we find you?
Well, we just have our website, which is Fairview-Partners.com. My email is Nels, N-E-L-S, at Fairview-Partners.com. We're an investment manager. We provide private equity funds for accredited investors in distressed debt. So we're raising a new one of those. Welcome to talk to anybody about that. And we are starting a gold equity fund right now. We've got it up and going. And I'd be happy to take emails from anybody.
All right.
Appreciate your time.
Excellent. We'll have a link in the show notes, as always, to your site there, Nels. Anybody interested, write us, kl@kerrylutz.com. I'll make sure that Nels gets it. And check out our Twitter feed at Kerry Lutz, Facebook page, Financial Survival Network, and of course, our home site, financialsurvivalnetwork.com. And Nels, been a pleasure having you. We'll talk to you again real soon. It
was really great. Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.